Welcome back to International Finance. I am Andy Kim, your Dr. Finance. We are trying to finish Chapter 7 about currency futures option. Now, there's a duality going on in call and put options, right? In the currency futures market. The value of a call option on 10,000 euro with a strike price of 15,000 US dollars is worth 1540.62 US dollars. If you don't remember this part, go back to my the video number 6 of chapter 7, right? We figured out this number, okay? The thing is, your right to buy euro currency, okay, from the investor's perspective, right? Your right to buy the euro currency, 10,000 euros worth, right? This is equivalent to the right to sell, okay? It is equivalent to the right to sell US dollars at a certain fixed euro price. The right to buy euro at a certain fixed price is equal to the right to sell US dollars for a certain fixed price of euro currency. There's a duality going on. It's the same thing from the perspective of the other currency, right? The first way is expressed in terms of call option. The second way is expressed in terms of put option. That's interesting. That's what's going on over here. Now, if the options finish in the money, they have the same cash flows, so they should have the same value today. Now let's check our intuition. Okay, math is always like checking our intuition. Some people think that math is like always getting the number, but usually, if you delve deeper into it, it's like checking our intuition, okay, and confirmed by the numbers somehow. That's the way to do it. Okay, so let's do it. Use risk-neutral valuation to find the value of a put option on 15,000 US dollars with a strike price of 10,000 euros. Now, hint is that given that we just found that the value of a call option on 10,000 euro with a strike price of 15,000 US dollars to be 1540.62 dollars, this should be easy in the sense that we already know the right answer. We're checking it. As before, US interest rate is 7.1%, euro rate is 5%, spot rate is 1.5 US dollars per euro, and 1 year forward rate is 1.53 based on the interest rate parity relations. No arbitrage assumption, right? Now, forward rate, we carry on over here 1.53, and then you can check out the binomial trees or chopstick trees, whether you like it or not. Anyway, so risk neutral method, we're going to do it. And then you see, right now, today, 10,000 euro is worth as much as 15,000 US dollars right now, based on spot exchange rate. 1 year from now, 1.53 is applied in the forward rate, but that should be the weighted average of upstate and downstate. Okay, weighted average of upstate and downstate. That will be like a forward rate predicted, 1.53. Upstate, we know that the spot exchange rate is expected to be over there, 1.8. We are assuming it, by the way. And then 1.2 in the downstate, which means euro currency getting stronger versus weaker. Okay, with stronger means what? The same amount of US dollars will be denominated in a lot smaller number in euro. Okay, you can buy the same amount of the US dollars with smaller amount of euro currency. That's what's happening in the upstate. So that you divide the 15,000 US dollars by 1.8 rate, then you will get 8333.34 euros, right? Upstate 1 year from now. Downstate, well, the euro weakens so that for the same amount of US dollars, you will have to spend a lot more of the euro currency. So that in the end, you're dividing it by 1.2, smaller number, so that you get a lot bigger number in euro currency unit, 12,500 in downstate. Euro devalued, euro appreciated, depreciated. Okay, we don't know the probability yet, but let's see over here. 15,000. Okay, right now using the the forward rate of 1.53 in risk neutral pricing, right? What was the idea? Upstate and downstate, you have those prices of underlying assets, and then you have expected value of your underlying asset at the end of 1 year. That's predicted by the forward rate. Okay, forward rate over here. Applying this to the same amount of US dollar, 15,000 US dollars, well, you get 9803.92 euros, right? That you see, and the idea is 9803.9 should be the weighted average of these two guys at the end of 1 year. So probability weighted average of upstate and downstate price, that's gonna be forward rate predicted price of 15,000 US dollars. That's 9803.92 euros. That is it. Now in this equation you have only one unknown, which is Q. Let's solve for that. Then you get 11/17. So that's this guy, and automatically it gives you this guy because this is just 1 minus. So it's gonna be 6/17. Then we move down to the next slide. You see probability, new risk neutral probabilities are assigned over here. Then what can we do? Now get to the option value in each different states of nature. Okay. Now this one is a put option to sell. Okay, put option to sell. Payoff of right to sell 15,000 US dollars for 10,000 euro. Okay. Remember, euro denominated price in upstate is a lot smaller, and you can sell it for bigger number. Oh, kachang kachang, you're in the money. So the difference should be the call option payoff at the end of year 1, upstate. Downstate, 0, because you don't exercise the right, because you know the price of 15,000 US dollars worth of asset in terms of euro should be 12,500. Okay, the put option gives you the right to sell it for much lower number, 10,000. Would you exercise it? And the answer is no. So that's why the put option value is 0. Now, two different states of nature. You have cash flow of your call option, the payoff. Two different states of nature. You have a probability. You can get the probability weighted average of these two. That's what's going on in the numerator, right? Probability weighted average of two payoffs of the call option. Okay, I don't know, put option, sorry, right? So that's gonna be the expected value of put option. Did I say call option? No, put option, right? At the end of 1 year. Now, what do? This is a risk neutral world. So you can discount this expected value of put option using risk-free rate. That's what's nice about risk neutral pricing. Okay, you don't have to worry about risk premium because everybody is risk neutral in this world. Okay, so what's the risk-free rate? 5%. Okay, so if you discount it, it's gonna be 1027 euro, 0.808, right? And then if you want to convert it into US dollars, just multiply it by spot exchange rate. Yeah, that's because it is today, right now. Not the forward rate, but today's spot exchange rate, 1.5. And if you multiply it, then you're going to get 1540. Voila, that's the same identical number as before, right? So let's go back over here, 1540.62. Yeah, there could be some rounding error, but yeah. So that's that. Over the next 17 slides, it's going to be checking our intuition back again, okay, using another example. Call option starting from one currency to the foreign currency, right? Right to purchase foreign currency is like right to sell my currency into foreign currency, right? Right to purchase, right to sell. They are the same thing. Okay. Now they have to give me the same option value. Use risk neutral valuation to value a put option on 8,000 British pound with a strike price of 10,000 euro. So this is pound to euro relation. Okay. So the spot rate is 0.8 pound per euro. And then pound based interest rate, let's say this is like 15.5%. Oh my God, 15.5%. Is there a crisis in Britain or something? Well, let's just assume it. Okay. And euro interest rate, 5%. In the next year, there are two possibilities where the, what is it? The British, the euro will get strengthened versus weakened as opposed to vis-a-vis British pound. So in upstate, 1 pound per euro, downstate, 3/4 pound per euro. Okay? Right. So, step 1, carefully figure out which is step 0. I say carefully figure out which is the underlying asset and which is the currency to price it. Okay. What is difficult about FX options, right? FX market is like, what is the base currency that we are using, and then what is the foreign currency that we are evaluating as an asset, underlying asset. Don't get confused. If you get confused, you're gonna screw up the whole thing, right? Of course, in your exam setting, I'm giving you some partial credit, so show your work, okay? But step 0, you want to be careful. So I'm going to tell you in the next slide one more time. Step 1, calculate risk neutral probabilities. You know that, right? In the 1 year from now or X month from now, right? What's going to be upstate and downstate and the expected value of the asset that you're interested in. And then the expected value should be the weighted average, probability weighted average of these two upstate and downstate prices, right? Then you figure out you'll be able to figure out the risk neutral probability. Okay. Then step 2, calculate option value as the present value of the expected value of the option payoffs. Okay. So next slide, step 0, carefully figure out which is the underlying asset and which is the currency to price it. Numeraire currency, numeraire. I don't know if that must be French word, right? Numeraire, denominator currency, numeraire. Very important concept, numeraire, in asset pricing anyway. So take a deep breath, I say, relax, all right? And read the statement carefully again and again and again until you are clear about it. No rush. I give you 24 hours to solve the problem, all right? So take a deep breath, right? Read carefully. And it said, value a put option on 8,000 pound with a strike price of 10,000 euro. So the underlying asset is what? British pound. It's an option on the asset that you are interested, okay, asset, and then you are German investor, let's say, or French investor, right, valuing everything in euro currency, and then the currency to price it is euro. So even though the spot exchange rate is given in the problem as dollar per euro, you have to convert it back into euro per pound. Okay, what you really need is spot rate of euro per pound, like 1 over 0.8, which is 1.25 euro per pound. Okay, for each unit of pound, that the asset unit, right, the price is 1.25 euro. Make sense? Now, also you need to convert all the spot rate in period one into euro per pound, right? So upstate is like 1, downstate is 1.3334 euro per pound. Okay. Next, what? Yeah, I said down, but I flipped it over here in our chopstick diagram or binomial diagram. Okay. Yeah, because it is just giving me the higher number over here, right? Maybe I should have said the other way around so that it is upstate. Okay, in this slide I should have said maybe upstate and downstate, right? But you know, as a sequence of reading the slide, right? You just upstate and downstate. We are just flipping it, right? Upstate, the pound price is higher. Upstate, a pound price is lower. Okay, pound price is lower. Priced in terms of euro, right? So lower, so downstate. That's all that I'm trying to say. Okay, binomial tree or chopstick tree is here. And then the pound price of today is over here. Notice that the strike price happened to be identical to today's price. Okay, it can be anything. Okay, but just in this example, it is identical. So we are at the money, right? In this option, as well in this problem, which means that the option is at the money at t0. Now what? Step 1, calculate risk neutral probability. Is set up risk neutral probability as Q and 1 minus Q, right? Just convention, right? And then, but to figure out Q, you need to find out the forward rate of euro per pound. That satisfies interest rate parity relations. For this purpose, you have to draw IRP diagram. You remember that the timelines, two timelines, and euro, and then the foreign currency, domestic currency and foreign currency, and then the spot rate and forward rate, and then the domestic interest rate 5%, foreign interest rate 15.5%. Using this IRP relations, if you do the math, you will be able to figure out it should be 1.136 euro per pound. Okay, right. So you stick in that 1.13636. The idea is this 1.3636 should be nothing but, my dog is barking, so I have to stop pretty soon. Now, this should be the weighted average of upstate and downstate prices, right? Weighted average, weight should be the risk neutral probability. So probability weighted average of these two should be forward rate over here, 1.13636. If you solve for this unknown Q, it turns out it is 0.409. Okay, good. Now we are ready to move on. Stick it in, yes. And then what do you do? Well, it's time to figure out the option value in two different states of nature. Then we're going to get the weighted average of these option values, right? Remember previously it was weighted average of the underlying asset price, not the option. But now once you have the risk neutral probability, you are focused on the option value. This is a put option. So in the upstate, the value of put option should be 0. Downstate, it should be 0.25 because the price of a British pound is €1 only, very low, but you can sell it for €1.25. That's a great, right? So put option value will be 0.25, the difference between this and that. Okay, now what? Get the probability weighted average of these two. That's going to be the numerator, right? Then discount this expected value of put option at risk-free rate. Why are you able to discount it at the free rate? Because we are assuming a risk-neutral world. In the risk-neutral world, nobody is risk-averse, so nobody is charging risk premium on it. So that's why. It took me a long time to figure this out. I know, it's difficult, I know. But this is the idea, using risk-neutral probability framework, okay? So if you do the math, you will be able to figure out the put option price has to be 0.14071 euro per pound. Now, notice you have 8,000 Great British Pound as underlying asset. So don't stop there, multiply it. Then you'll get the put option value, 1125 euro, 25.71 euro for your asset that you're interested in. If you want to obtain the value of put option in terms of Great British Pound, well, multiply this guy by 0.8, right, spot exchange rate, 900 British pound, you will find out. Okay, fine, that's it. Now let me stop over here, and then the next set of video will be about finishing the whole, the rest of the slides. Okay, so thanks for watching. Bye.